Happy New Year to everybody. And we have a very interesting paper today. As you can see, that is a combination between behavioral finance and efficient market hypothesis. So traditionally, if everything is in line with efficient market hypothesis, we will not see the role played by individual person's opinion or mood, etc., etc. And nowadays, the underlying theory is not new, but the new is the measure of this indicator. So I have read some papers that it's quite popular actually. Recently, I saw some paper that they discussed how American firms reacted to the US-China trade war, and they used the earning conference calls. They count how many times that the trade war was used in that conference calls. And the similar thing, when they investigated the Chinese firm's reaction, they used the text contents of a firm's annual report and to count the word, how many times this word appeared. So the same line of argument here, but I can guess the contribution, the innovation is more on the measurement, because I know this is the tone of managers speaking, and I wonder how they captured this. And so this is the underlying theory. So we have a group of people who contributed to this project, but the leading author is Junhong. And I do not have any information in front of me to introduce Junhong as I did for other authors, because I know Junhong well. And Junhong actually got his, I think, UG from Xiamen University, China, and then got his master's and PhD from University of Durham. And then he worked for Sheffield University for some times. And interestingly, he came to us just before the COVID, and he left just after the COVID. So that's the short experience that we had, or interaction that we had with Junhong. But I had much more connection after he left. And then I'm sure he's a hardworking scholar. He is very productive. He produced some very good publications. For example, in Journal of Corporate Finance, not only one, but twice at the least, as far as I know. And also Journal of Banking and Finance, etc., etc. So Junhong is also now involved in some journals. So I hope we can just keep our eyes open and watching the development of Junhong's research in the future. So I give the floor to Junhong now, if you are ready. And I understand we only have Junhong who is going to present. So we are very curious to hear how you proceed with this to provide the answer to this question. Thank you.
Okay, thank you so much for Professor Hong's very very nice introduction about me. It's always a very good feeling, I think, coming back to SOAS. And I also think SOAS is one of my special places. I think I've been, as Bo was mentioned, I've been working here for like 2 years, and unfortunately, because of family reason, I have to come back to Sheffield. But it's always a very like another home, like to me, a very nice area and a good environment. And I knew quite many of the people here, and I think it's good to see many of here today. And so I think back to the paper, this about the earning confidence call. So I think from the title you can see it's quite straightforward. We try to see the predictive power of the tone surprise on the future crash risk. So this paper is quite preliminary. I have not submitted to any journal yet. So, but I think we are planning to submit a very short the future. This paper was co-authored with two of my students, and one is current student Yu Zhe, and she now is the 40-year student, and the previous student Avis, and now is working in the immunity therapy, and also Professor Chris Alcott. I think I don't think he will be here today, but yes, I think this the joint work from for us. Okay, so so I'm sure like everyone knows about earning confidence call. This so I to give some backgrounds, okay, about earnings confidence call. So it's a regular event hosted by company, okay, and typically like quarterly basis. So especially after they release the quarterly or annual earning reports. So I think it's a very good communication, opportunity for the insider, saying the manager like CEO, CFO, and communicating with the outsider, saying the analyst, investor, or other stakeholders. So these other stakeholder can include in the media and also anyone who are interested in your company. So I think there's many research was engaging in this material, because I think they believe this and unstructured data also can provide something interesting information. Okay, so but from the company point of view, from the investor point of view, it's very important channel in terms of communication between the manager and the market. And I think this normally conducts over the phone or online platform. So important structure of the earnings conference call is normally is involving in the presentation at the beginning. So the insider saying the manager, like CEO, CFO, give some briefly talk about the earnings performance or anything they want to share with the media or analyst. Then will be followed up by a Q&A session. So I think this is very important. This most important session for the earnings conference call, because during this Q&A sessions, everyone can be able to ask the questions. So I think our research most based on the Q&A sessions of earnings conference call. So we know like this. I think most of the earlier research most focus on this prepare written disclosure. Okay, because we talk about the information disclosure. Most of focus on the annual report, statement, or press release. Okay, so somehow earnings conference call is different from this prepare script, because it's much more voluntary. So it's less informative and less script. It means there's opportunity for people asking questions. So then, because spontaneous and interactive nature of the earnings conference call, so and then there's opportunity to actually export something information beyond the hard information maybe company is willing to release. So because of these natures, so even earnings conference call is a voluntary by nature, but sometimes can also be involuntary, because the analysts be able to ask the questions. So I think this huge of the research in this area. So the prior research also highlight the incremental informativeness of this call from market. Okay, so I think there's two information. I think one information I mentioned earlier is in the earnings conference call, they talk about the quantitative data. So especially in the presentation, they're talking about the firm's performance, especially financial performance, earnings, like earning per share, revenue, margins, everything. And also there's also talk about some specific information such as detailed segment data is not in the press release. Okay, so this is something they'll be asking more probing something more detailed information. Is not covered by annual report or quarterly report. And in addition to this quantitative data, I think there's another data information we call soft information. So this, in terms of soft information, from any content call, so including the manager's tone, language. Okay, so this is not quantitative by nature. It's the qualitative. There's not numerical data. So I think this a lot of research actually discover this soft information to provides a lot information beyond the hard information. Okay, so including the confidence level of or any underlying risk associated with the company. So why is earning call matters? So according to literature, I think they say further a lot of people actually found earning call be able to provide additional informativeness to the market. So the paper was found this be able to associate with higher stock return and trading volume. And also, I think they use in a different way. It's not just the conference call, and also in the conversation, the engagement during the call, be able to provide more informativeness. And another very good function of the earning conference call is they be able to reducing the information asymmetry. So there's research also found, a firm conducting more regular earning conference call be able to reducing the information asymmetry. And another set of the research also focus on the market reaction. So because the tone, earning conference call be able to drive the market reaction, I think they focus on the normal return, the trading volume. And they because this kind of additional information be able to trigger something market stronger reaction. And also the research also tried to exploiting unexpected earnings. So it means this earning conference call, I think especially in this paper, was focused on the managerial, the vocal emotion. Okay, so they have different way to because it's very, very rich data. Okay, so it's unstructured data. So you can see many research try to abstract something good information for their research purpose. So based on this paper, they found they be able to predict unexpected earnings. So for I think there's quite many of the research regarding the earning conference call. So as what I'm saying, they're using a different methodology. They try to try to address different research questions. Okay, but overall they do find earning conference call be able to reducing the information asymmetry, making the enhance the transparency of the company, and also trigger much stronger market reactions. So so the difference between our paper to previous paper is like we do find previous paper to overlook the dynamic nature of this dialogue, because saying Elon Musk, I think every way, I think the manager do have their way to conduct this earning conference call. So I think there's research found manager characteristic to influence the tone of earning conference call. So every strong manager, they have the way to respond to the questions. Okay, and this something will be leading some biased result, because it will not take this into consideration. And also and the way we construct this tone surprise, we try to we try to be able to control for this inconsistent of the tone change. So in that way, we be able to remove some unobserved bias associated with the tone in terms of methodology. So in this paper, we developed a novel univariate measure of the tone surprise. Okay, so we investigating the significant extremely the tone change during the earning conference call. So this change was driven by the material revision or unexpected deviation. So and then be able to present a critical information signal for market participants, and we expecting they are more likely to serve a predictor of the future stock market crash. So our research questions is we assess whether this tone surprise can predict the risk of the future stock price crash. So in terms of contribution about this paper, I think as we mentioned earlier, we try to introduce the innovative, the measure of the tone surprise. Okay, so based on the extreme tone shift within a probability distribution. Okay, so we leverage all the Lauren McDonald's financial dictionary because I think this is the most common use in the finance research. So different from other people when they are trying to exploit extremism in terms of the tone surprise, they rely on some different dictionary. So we using the more common use the dictionary to be able to follow consistency and the comparative with the earlier research. And also because of this methodology, we're able to classify tone surprise either positive or negative. Okay, so we be able to evaluate the difference predict power for the future crash. And the second, I think, as what we earlier mentioned, this kind of extreme tone change or unexpected tone change be able to mitigating and observe heterogeneity and filtering out of non-information tones and ensure the tone surprise acting as a clear as possible signal of risk. Okay, and the last one, I think we do found, I think research do found our tone surprise provide incremental predictive power over the traditional tone surprise, and offering is much more fresh insight, compared to prior research. There's a dynamic crash risk linked to the narrative of disclosure. So, and the hypothesis, I think back to the, for people who are not very familiar with this crash risk literature, I think there's a literature about where this crash risk coming from. I think they were talking about manager to have access to private information they outsider do not have, and manager might be conceived this bad information to protect their self-interest. Okay, so and they withhold this kind of negative news, but however their power ability to withhold this bad information is limited, so leading to the build up undisclosure bad news. Okay, so and then when this news is coming to the certain point, okay, certain level, they can trigger something, stock crash, price crash, when the insider reach the limit and excess the abundant options. So this be suddenly when this negative news is released, and you can see market crash. Okay, so this stock market crash, I think, reflecting on the market sudden adjustment to the negative news. So the a lot of research was especially research in this area, especially in terms of information asymmetric and also agency problem, and how they link to the crash risk. In our paper, I think we're different. We try to see importantly this earning confidence call be able to provide some predict power to this crash risk. So as what we mentioned, I think unlike the prepare report, okay, so information from the earning confidence call, especially in the Q&A session, provide kind of real-time engagement platform. And using this platform, manager have been asking the questions. Okay, so manager, the analyst be able or investor be able to asking the questions. I think this increasing the scrutiny, somehow limiting the narrative of control of what they can say or what they want to say. So the linguistic tone in the earning conference call serve very of a soft information resource. so complement to the hard information in the financial report. So, and according to this information content effect of verbal cues, okay, the tone surprise may signal confidence or raise the red flag about the company's future prospect. So, if the positive tone, we're expecting they have much more strong, much more favorable outlook on the firm's futures. If the negative tone, and probably as well saying maybe raise the red flag, and also because the negative news, especially negative news, is somehow contradict to the manager's intention. So unless somehow they have to release this negative, has been challenged by releasing this negative news. So this negative news maybe signal something, previous withhold bad news, or somehow correction from over optimistic or past disclosure. So I think our first hypothesis is the tone surprise can predict future crash risk. The second hypothesis is about we try to compare the predict power between the positive tone change and negative tone change. Okay, so I think the underlying mechanism rely on the impact on the tone change actually on the crash risk depends on the genuine or accuracy nature of the information. Okay, so if the information is more accurate, more genuine, then probably they will be somehow more strongly reacting to this tone shifting. So I think there's a research also found, firm be able to manipulate this confidence call by calling the bullish analyst to asking the questions. Okay, so the company do have an incentive to try to release somehow more positive news, try to avoiding something, try to for something different purpose. So the positive information somehow have less credibility compared to negative news. Okay, so the research do found negative tone shifting are more powerful impact because as manager maybe less reluctant to disclose unfavorable news unless something necessary have to do it. So in this reason, okay, so you can see prior research do found negative information is generally considered more credible compared to positive information. So then we propose our second hypothesis is the predictive power of the negative tone surprise on the future crash is more pronounced than that of the positive tone surprise. So in terms of our main finding, okay, in case I don't have time to finish everything. So our findings show the tone surprise to predict future crash risk. And the second is negative tone surprise have more predict power than positive ones. And we also find immediately market action following the tone surprise. The last one, I think the impact of tone change on crash risk is more pronounced when the change is unexpected. So the change is deviated with the expected norm. So we categorize in this paper by the tone in the 10Q and the industry benchmark and also prevailing media sentiments. So the data, I think we follow the literature, we're using the US listed firm from 2010 to 2019, avoiding the crisis before and after the COVID-19 impact. And we excluding some less charity firm and excluding the financial firm. So overall, our firm cover 33,000 firm quarterly observation from 2,500 firms starting from 2010 and 2019. So I think one of the contribution in our paper, we tried to introduce the tone surprise. Earlier, I think that actually tone measurement, they try to, as what I'm saying, they try to use a different dictionary, for their research purpose. But however, it's very difficult, because the dictionary is the customer dictionary is very difficult to comparison with the prior research. And also, a prior research doesn't take this nature, dynamic nature of this dialogue into consideration because, as I was saying, the manager might have his style to deliver this earning conference call. So some people might be more positive, optimistic. Doesn't mean this have something information compared to people are less optimistic and less something change. Okay, I think we think the change is extremely important, and the change we also taking this salient change into consideration. It's not just like normal change. We want to see this abrupt tone shifting to provide something incremental information in terms of risk and also potentially affecting the crash risk. Okay. So what we're doing, I think, as we were saying, we adopt this sentiment analysis framework from the Lavalon and McDonald 2001. I think it's most popular, the one to create the tone, measurement. We for the literature, we calculate the tone and tone change. Then we are, in order to construct this tone surprise, we are assess the tail of the probability of distribution of the tone change. So in that sense, I think the tone surprise is equal to 1 if the tone change is falling 1.28 standard deviation above or below to the mean. So above will be the positive tone change, below will be the negative tone change. We're also using the different probability level, 5%, 1% for the robustness test. Okay, so actually this measurement try to capture extremely negative or positive management tone change, and according to the top or bottom 10% of the distributions. So this the see the graph. This the yellow part. Below the yellow part is the 10%. And below the green part is the 5%. Below between this red part is the 1% probability level. So for the crash risk, I think it's quite standard. We follow the literature, capture the crash risk based on the negative skewness and down to up volatility. And I think the first one is capture the moments, the skewness of the volatility. The second is capture the second moment. We also, I think the crash one, another one is the dummy one, is the same idea as what we use in the tone surprise. I think they capture the 0.1% of the crash probability. Okay. For the robustness test, we also try to investigating, try to using other measurement of the univariate crash risk, like very at risk in a different confidence level, and also expected shortfall for a different confidence level. So I think the baseline model is very straightforward. I think we have the crash risk in the left hand side and the tone surprise in the right hand side, and we incorporate those positive and negative tone surprise, and also a number of the control variable, including the earning surprise, because I think in this literature there's earning announcement drift. I think it's been saying probably affecting these volatilities. We also use the firm fixed effect and also the quarterly fixed effect. And for the standard error, we cast at the firm level and the quarterly level, try to provide most accurate and most cautious reference for the result. So, and this is the main result. You can see in the first three columns, I think is we have three crash risk measurement, and the first column, first row is a surprise, negative surprise. The second is positive surprise. You can see from here, you can see positive surprise. Positive surprise can mitigating. Okay. Is negative associated with the future's crash risk, and a negative surprise is positive associating with the future crash risk. Okay, so in the column 4 to 6, we including a number of control variables. The results still consistent, have same prediction in line with our hypothesis there. So the result, I think you can see there's a positive and negative tone surprise will be associated with the decrease and increasing in the expected stock price crash risk, even control for key determinants such as the earnings surprise. We do find, I think I'll go back to here. I think you do see here, if you compare the magnitude between the negative to positive, you can see negative has much impact compared to the positive one. Okay, so as we see here, everything is easy to comparison. Just here, the coefficient is bigger, but you make it as a magnitude context, you can see one standard deviation of increasing negative tone surprise is associated with 1 to 1.1 to 3.4 percentage point rising in the crash risk. And for the positive one, it's about the 0.2 to 2 percentage point reduction in crash risk. So in terms of magnitude, we can see the negative tone surprise have much more predictive power compared to positive tone surprise. I think it's in line with our second hypothesis, saying the negative power are more salient and expected as managers are less reluctant to disclose unfavorable information. So I think the second session of this paper, we try to further examine the market reaction to managerial tone surprise. So we employ the short window event study methodology. So it allowing to capture immediately market response by calculating the cumulative normal return following the call. So, and if the table you can see quite straightforward, and the negative tone surprise is associated with the immediately marking negative response. And the positive, the right hand side is positive tone surprise is is showing is positively associated with the market reactions. And in terms of magnitude, we do see the negative tone surprise has much higher compared to positive surprise. We construct this excessive cumulative normal return based on different model, based on market model, compel model, 3-factor, 4-factor models. The result is consistent. So try to control for other like determinants like supply, earnings surprise. We also regression on the car on the suppliers negative and positive measurement. So consistent with earlier research, earlier result, you can see positive tone surprise is positively associated with car. And regardless the 1 day window, 3 day window, 3 days window, or 5 days window, a negative tone surprise is negative associated with the car. Okay, in a different window time. So the result, I think here is seeing the summary. In summary, I think the results market reaction. Election, in my opinion. Hello, any questions? Hello? Sorry, is any questions? I think boy, you are muted.
I think Junhong, that noise was just a background disruption. Yeah.
Okay, I think probably I probably need to. Is any questions so far? So if not, I think I can continue. Then we can discuss. This is the first time I think I just finished. Actually, just finished the science like this morning. So it's the first time I present this paper, and as saying, I think probably there's a lot. Any comment and suggestion will be welcome. Okay. So I think the result you're seeing suggesting there's a market.
Yeah, Junhong, you just continue. You continue, please.
Okay.
Yeah, I do not know what happened. Yeah, please. Yeah, thank you.
Okay, so you can see the market like positively reacting to the positive news and the negative reacting to the negative tone surprise after the earnings call. And specifically, I think one standard deviation increasing the negative is associated with the about 1.1 basis point, okay, in terms of CAR. And for the positive tone surprise is also associated with 0.9 basis point increasing in CAR. Okay, so based on the 5-window result. So and the result I think showing the impact is economically significant as well. As we shown, the negative news has much more stronger impact compared to positive tone surprise. So I think what we then try to refine the surprise, tone surprise. We try to, because one of the reasons we see the tone surprise have much stronger impact is because this unexpected. Because when we see kind of change is in the extremely tail of the distribution, it means something is rare incident. Okay, it's not very common happening. So then the market might have much stronger effecting because the kind of incidents. Okay, so then we refine our measurement and constructing the tone surprise by incorporate unexpectedness of the tone change. So so we hypothesize saying the influence of the managerial tone change on the stock price will be much more pronounced when this tone change unexpected. So why is this reason? Because it was saying, when this change is unexpected, it means this change might be reflecting something previous unknown information or indicating the manager has much withholding something information, and also because it kind of suddenly unexpected release information can promote something more stronger reassessment of the firm prospect and also be encouraging something more risk assessment, and can be also trigger something more emotional response for investor point of view, because the company are always doing bad and suddenly doing good, and this company have a trigger much more suspicious and also much more emotion try to and can likely leading something market overreact. So for this reason, I think we construct unexpectedness based on the tone change deviating from the expecting norms. So first is the 10Q tone. Okay, the 10Q is a company, the quarterly annual quarterly report. Okay, the second one is from the industry peer effect. Okay, the third one is the median sentiment, media sentiment. So in order to do so, we constructed this tone change. The reason we follow the literature to construct this tone change using the negative minus positive divide by the negative plus positive tone. Okay, so for this reason, so we're not able to incorporate for the positive tone change and negative tone change. Okay, because the impact of this formula actually proceed for the negative tone change. But however, for the positive tone change, it just have a negative the negative sign on the thing. So it'll be exactly the same, apart from the different is a reverse sign there. Okay, so what we're doing, like using the tone change and interact with the surprise, okay, unexpectedness. So the first one is like deviating with the 10Q tone. So for the dummy one, the tone difference is equal to 1 if the tone change of earning conference call is more negative than the tone of the 10Q. Okay, so because I think that both of them based on the same dictionary, so we're able to compare the difference. Okay, so if we ever see the earnings conference call is more negative compared to 10Q tone, then this dummy equal to 1. Okay, so we see when this tone change is unexpected, this interaction term is much stronger, because here is negative tone change. Okay, so this unexpected negative tone change is actually positively associated with the crash risk. So if you're asking me what's the positive one, I think it's just the the magnitude will be the same, but just different, just putting the negative here. So it means based on our methodology, then positive tone change, unexpected positive tone change will be negative associated with the crash risk. So we also try to investigating the difference between the tone with the media. So for this reason, we're using Robin Pack, the media sentiment. Okay, so this sentiment actually is evaluated from there of the sentiment, especially in the earnings evaluation. So the very similar is what the earning control are focusing on. So we introduced this dummy one. So if the tone change, okay, if tone change in the earning control is negative, we call it 1. The tone change in earning control is negative, and while the sentiment change in the news media is non-negative, will be equal to 1, 0 otherwise. The reason we can know with comparing the difference, because the sentiment based on this Rowan Pack, the way of calculating the sentiment is different from us. Okay, so therefore we just be able to compare the direction of the tone change from our earning control with the media one. So the result is still expected, is in line with our expectation, and you see this negative, unexpected negative tone change to positive associate with the future crash risk. The last one, I think we also think that the industry peer do very important as a comparison. So in that way, we take a value of 1. This dummy will be taking the value of 1 if the firm change is more negative than the median level of its peer firms. Okay, so and then you can see the result is somehow apart from the second one is not significant, and the other two are 5% significance here. It means there's unexpected negative tone change based on the industry peers will be also positively associated with future crash risk. So I think we also tried. I think next paper we try to see this dynamic of the predict power. So in current settings or empirical setting, we try to predicting a quarter ahead of the earning conference call, because earning conference call is conducted every quarterly. So what we're doing for the crash risks, we are measuring from the first earning conference call to the next earning conference call. Okay, so this only one, we try to see the predict power in the 1 quarter time dimension. So we try to see if this counted earning conference call tone surprise have somehow predict power beyond 1 quarter. So what we do is like we do some further regression in this time. I think the dependent variable will be the 2 quarter ahead, 3 quarter ahead, and 1 year ahead. So you can see for the negative tone surprise, I think they can extending for the 2 quarter ahead following the call. Okay, for the first set of the regression, the negative tone surprise have a predict power. However, for the positive tone surprise, do not have any predict power after the 1 quarter after the earning conference call. Okay. So we also incorporate with the previous negative and positive tone. Okay, because the earlier research do find negative and positive tone be able to predict the crash risk. Okay, so we do the same for a comparison. Okay, so when we include negative and positive tone in our regression, we do see our tone surprise has much predict power compared to the regular negative and positive tone. Okay, so it's showing this surprise and unexpectedness somehow play much more important role here. They can carry something incremental explanatory power for the future crash risk above or beyond the traditional measurement of tone. So for the robustness test, as we mentioned earlier, we also construct a tone surprise based on the different confidence level. So most of this data was this result presenting today is based on the 10% level, and then we also different confidence level in the 50, 95% and 99%. The result is consistent. We're using a different way to sentiment textual analysis to capture the tone. The result is the same. And also for alternative crash risk, we also capture the crash risk based on the VAR, value at risk, and also for the tail risk expected shortfall. So in the different confidence level, the result is still robust. So I think overall the implication of this paper, I think for investor, I will try to provide some implication from our research. For investor, I think the understanding this tone surprise, I think during the common call is crucial for the risk management and also for the investment strategy. Potentially can helping to avoiding the significant loss from the stock price crash. And also for the policymaker, I think our study highlight the value of the manager tone surprise as a strategy to detecting and mitigating potential corporate crash risk. And the last one, I think our finding was suggesting to improvement the transparency and the disclosure practice within the managerial communication. Okay, so I think this is pretty much everything I need to cover by this paper, this research. Thanks so much for here today.
Thank you, Junhong, for the sophisticated paper. And I think this is initially I thought this is but I think it's a market is sentiment and market reaction and market. So there is a big literature on this topic, on this larger topic, and your contribution is more on the measurement. It's you extend to the manager's tone when they were speaking at conference calls, and then investors will derive the information from that. So I would take off with the 3 questions, and then I will open the floor.
Thank you.
First of all, think about if I was a manager and I was frequently, I know I have to speak on behalf of the firm to the public. Sometimes I adjusted the tone of my speak deliberately. So the information that the tone that managers sent out when they were speaking, particularly, they know these conference calls are important for investors, therefore for the firm value. So there is agency problems here as well, because if I do that deliberately, the information that you got is more than what you are saying. So that's my first question. I know a lot of, politicians are doing this all the time. CEOs are doing this all the time. Even, in the high education sector, we need to talk about things in a very political way, so that, in my word, deliberately use this kind of tone. So that's one thing. Are you really talking about the economic things or financial things, or are you talking about something else? But there are more than that to me. Secondly, if my first comments contains some justification or information, that I would say in your control, you need to know who was speaking during that time period. So if, for example, this year you have information or data about the tone in general, but who are at the conference calls? Do you know them? Or is the CEO, is the CFO, or CRO, chief risk managers, for example. So do you need to control the personal characteristics of those managers or the traits? So in general, we will control some traits, CEO's traits, etc. So do you have that information? Do you think you need to control them? I did not hear, but maybe you have done some. I know the information is very difficult to obtain, but you can look at who were there and their CVs. So that's the second one, which is related to the first one. My third comment is on your econometrics, so particularly endogeneity problem. Do you think you have the endogeneity problem, particularly when you do the regular run, let's say long run? When you do, even the study is better because it's, you just keep a very short window. So in that, before that, you had some estimation. How did you consider the endogeneity problem? Because how I speak can be affected by this morning, the newspaper. If I read something, I know the market, there is something market there is going on, then I can change my tone. So do you think there is an endogeneity problem in this set of estimation? So I will stop here, but my purpose is to kick off and to stimulate more questions.
Okay.
Thank you.
Yeah, thank you so much for these three very important questions. I think I'll try to see if I can answer in my best ability. Okay, the first one I think is right. I think one of the you mentioned about this kind of the manipulating and deliberating in terms of when the CEO or CFO when they conducting this earnings conference call. This right. So this reason we introduced this surprise. Okay, so this surprise I think is based on tone change. It's not based on tone, the level of tone. It's based on tone change. So using this year's divide minus this quarter minus last quarter, and also we try to capture this extremely tails in the both the positive tail and negative tail, the bottom tail, the top tail of this distribution. So the reasons try to avoiding this manipulation. Okay, so everything. I think it's what I mentioned. I think manager do have their characteristic in terms of the conducting this earnings conference call. So some people might be over optimistic. Some people might be less more pessimistic in terms of when they are talking about their performance. Okay, so we try to capture. We not just capture the change. We capture the extremely change. The suddenly change. Because if the people are pretend, okay, they cannot pretend. If suddenly one day they are very different, they will try to capture this status. Okay, so like top or bottom tier of this difference. So and then we see if they are in the extremely different situation, we think there's something informativeness in terms, I think, the predicting for the future crash risk. I think so yes, I think the reason I think I'm doing this one is just one of things to address your questions. I try to avoiding they are manipulating or deliberating in terms of their talking, and also I think in terms of the context we not focus on the presentation. Okay, so we all the data we are conducting this textual analysis based on the Q&A rather than presentation. Your presentation is much easier; they can do things. Okay. The Q&A is when the analyst and the investor asking the questions, they have to respond. Okay, so we try to see the kind of response can be contain something more incremental information compared to the presentation. Presentation, they prepare they can talk about whatever they already prepared. But once that questions, you know, especially the analysts asking very, you know, very harsh questions, the kind of scrutiny can be very high. So under this kind of pressure, and I think, you know, the manager have less, you know, autonomy actually to manipulate information as they wish. Okay, I think I'm not sure I answered your questions for first one. The second one is about the I think second one is about the I forgot the second. Sorry.
The second point was on your control variables and whether or not you needed to consider some traits, personal traits of these managers.
Yeah. So yes, I think we do have some you know, control variable from the you know, saying earning conference call variable. So in terms of who are speaking. And also, I think have a word count, how many, you know, I think we do be able to distinguish the questions and answers as well. So, yeah, I think this something could be something interesting to getting more granular data. I think about it's not just for the purpose of this paper, but I think for the more interesting research can talk about what kind of questions they're asking and how they respond differently, and what kind of information they disclosure, and what kind of market reaction to this as well. So yes, I think we control for this thing, but we do not explore something beyond the current paper are doing right now. So, but I think this is quite important thing we need to control for it. The third one, I think about endogeneity. Yes, I think there's an endogeneity problem about this paper, this research. But the focus of this research is not try to address the endogeneity. I think we try to focus on the predictive power of the tone surprise. Okay, so yes, there's endogeneity there. There's something this you know, tone surprise might be reflecting something unknown information behind this surprise. But what we're saying, which we try to, you know, rather than addressing this unknown information behind the tone surprise, we try saying this tone surprise can be able to predict future tone change. So it's very different. The paper, I know probably for everyone look at on very pure like corporate finance research, probably this is some problematic here. But we are looking on more not more everything more in practitioner point of view. I think it's important. Okay, so we say this kind of tone surprise, no matter what information was hidden behind this surprise, then they'll be able to predict the future's crash risk. I think it's very important. Okay, so maybe this tone surprise might be reflecting on different information. Okay, but we do see this impact there, and I think it's important from the investor point of view, and also important from the regulator point of view. I think, you know, try to different predict power is somehow the focus of the paper rather than endogeneity. So they definitely have endogeneity here. So but it's not the focus on the paper.
I see what you mean, because the paper is more macro structure direction rather than corporate finance. But I do see this, you know, giving my background. So I now thank you, Junhong. I now would like to open the floor and see whether we have some more comments or questions, or do I see some hands here? Is there any comments here? Tulu.
Mark.
Oh, it's a comments. Yeah. Tulu, why don't you come? Oh, we first of all, thanks, Tulu. And who is? Sorry. Can you introduce yourself, please?
Hello, everyone. Hello, Professor. Thank you very much for your fantastic presentation. I just have one question. I look at the result. I know you set the firm fixed effect and also the time fixed effect. Will you ever consider industry fixed effect, or do you think the industry fixed effect is not strict enough in this case?
Okay, thank you so much for your questions. But if you're using the firm fixed effect, there will be not longer to using the industry fixed effect. Yeah, so this is what I think. So they will be removed because the multi-collinearity problem. You're not able to doing the. I think we have, as I forgot to mention, another robustness test. We try to using the firm fixed effect with the interaction between the industry fixed effect with the year fixed effect and the quarterly fixed effect. Okay, so this interaction, you're not able to doing the industry fixed effect alone because you're already using the firm fixed effect. So, but in other robustness tests, we're using the interacting with the industry with the quarterly fixed effect.
Okay, thank you. Thank you.
Thank you. And any other questions? Yeah. I think we got a message here. Tulu actually agreed that, when they were speaking, they know what they were speaking. It's not spontaneously, to be honest. So, so that's that's the way that. And I really want to hear more. This is an interesting topic. And sometimes people link this type of measure to real activities. But Junhong's paper links this type of measure to market. Yeah. So, but they added Tulu. Thank you for coming back. Tulu, please.
Yeah, just to come in briefly, since you have mentioned my name several
Good to see you anyway.
Yeah, I wanted to give support to the first issue that you raised, that executives are now more deliberate the way they speak, because now all their statements are actually put into artificial intelligence. They know that the markets actually do this. So they are deliberate in the use of their words and also in the use of their tone. One other area I wanted to come in is in terms of the control variable. Okay. The control variables, rather, especially with regard to personality. Who speaks matters, especially from cultural background. Okay, the way an African CEO speaks will be different from the way an Asian CEO speaks. I don't know if you actually consider that, especially when there's a change in CEOs from one year to another.
Yeah, I think it's very quick questions. I think as what I mentioned, I think this is very important. I think research do found, different CEO, they can have a different way of the tone. Okay, so in the conference. So then what we do is like we're using the changes. So we'll be able to removing this heterogeneity of the CEO. So of course, I think it's saying we have different background. So I think there's research found the CEO background in terms of their culture, their gender, and their, I think, this kind of the gender, the age, their optimism, okay, overconfidence, they do affecting the way they are, conduct this earning conference call. So therefore, we're using the difference. So like we try to remove the kind of, CEO or manager heterogeneity here. So if I say what I'm talking is very different from you talking, but I think a comparison is me compared to my past, not compared to other people. So it's very similar when we are doing the fixed effect. We try to addressing the firm fixed effect based on our methodology. I think here is saying we try to address the kind of CEO, characteristic heterogeneities based on our methodology. I'm not sure I answer your questions because it's not, of course, you talking, I'm talking the style quite different, but I think our methodology is based on me compared to my last quarter, or you compare your last time talking, okay? So if you are found today's talking is very different, very surprised compared to earlier talking, then we think this somehow have more incremental information from there.
Yeah, but then you still have to consider when there's a change, because you are looking at surprise from one quarter to another, isn't it?
Yeah.
There may also be a change in CEO from one quarter to another.
Okay, you mean the CEO turnover thing?
Yeah. Yeah.
Okay. Yeah, I think probably we can. I think yeah, I think you're right. I think we can probably maybe to have like a CEO fixed effect here to address these issues, or like CEO turnover here. But I think the majority, I think based on our 10 years here, I think it's 10 how many years we have I think maybe only very small subsample have these issues. So we can do some robust tests, removing the sample and to redo the test again. But I think the 9 years, I guess I think most CEO can last for 10 years during this sample period of time. Mm-hmm.
Yeah,
I think your comment is right, but I think we need to do more robust tests on these issues.
Thank you.
That's great. Thank you for the addition. And yeah, I think you emphasize. Oh, yeah.
Hello,
so since we have a new question, your name is quite long. Yeah. How do I pronounce your first name?
Sasha.
Okay. So can you, please.
We met before, but long time ago,
Okay.
Maybe you can stop sharing because.
Yeah, stop sharing. Yeah.
Oh, okay. Yeah, thank you.
I stop sharing. Yeah.
Yeah, you can stop it. Yeah, thank you.
I think I already stopped sharing.
No.
Yeah, you already.
Yeah, I think I didn't sharing. I was stopped sharing already, so I'm not sure.
Okay. Oh, I see. That's I'm still playing these teams. We mostly use Zoom. So I'm Sasha Tolera. I'm from University of Birmingham. So I'm ex-colleague of Junhong. So Junhong, finally I see what you are working on. Because I and Sushin, we just speculated because we work on a similar topics and using earnings calls. Like just a few things, like few comments. In terms of endogeneity, well, you said in your title it's predictive, and it's easy, but theoretically you can some sort of control for media sentiment before earnings calls. Mm-hmm. In terms of measurement, you try to push heavily your measurement story, and first of all, techniques are a little bit outdated. I would say like 10 years old. Even though I think like 2 or 3 weeks, Logran was discussing one of papers that use this fancy new ChatGPT based models, and he say, my kind of dictionary from 2011 is better than whatever you create. But these questions overall, dictionary Logran McDonald, first of all, you don't report descriptive statistic for your negativity measure, and you will have it extremely low, right? And there are issue of picking up, exactly sentiment. Another thing, for instance, your presentation, if I say your presentation is not that bad, is it positive sentiment or negative sentiment?
Positive, negative, yeah.
Yeah, if I say it's not that bad, there is bad word there, and bad word, you pick up negativity. But what I mean positivity. And this is kind of the way how you deal with this. I don't know, like, exactly, because whenever it comes to dictionary-based approaches, it's kind of dictionary specific, and it depends how you define it. And there are issues with content, and it doesn't matter whether you use Laura McDonald or Vader, you know, like we used this Finbert like heavily, where we get, you know, but I don't want you to write my paper based on my suggestions. Obviously, everybody. The way how you defined your measures, you based on questions and answers.
Yeah.
Or only answers?
No, question and answers, both.
Okay, so some questions, and that's coming to, let's say, composition of agents during your question-answer session. Today, you have more kind of analysts, like female analysts, and we find are likely to be more negative. And tomorrow, you will have, you know, fewer female analysts asking questions. And then you have your shock. Not because of content, but because of composition of people. And that's kind of, and another thing, yes, CO is present, but CO sometimes it just plays kind of facilitating role. You know, like, Junhong, I would like to ask you a question and say, please answer that question. You know, like, it just, this is the way they communicate. So, right, these are some sort of comments. Obviously, descriptive statistic would help for both your call neck measures, for differences and abnormality. Abnormality, kind of, everything negative is likely to be abnormal. This is my expectation, and somehow to deal. But yeah. Interesting beginning, yeah.
Thanks so much for the comment. I know you're expert in this area, so I think this, I know I'm saying I just finished the slides this morning, and so yeah, I think all the comments are taken. I think very important. I think it's mentioned. I think back to the Bohong's comment about the endogeneity predict. The reason we try to avoid things like using the predict power, so try avoiding these issues to mentioned by viewer. I'm not sure we'll be okay to get with these endogeneity issues, but I think it's what we do. In terms of methodology, as you're right, I think in terms of methodology, I think compared to prior research, it might be a little bit simple. But I would think, you know, I think earlier research, not just using the tone, they're using like engagement, they're using the pitch, they're using the, I think now like they try to, as what I mentioned in the literature, like literature review, they were saying they try to capture the different dimension from this earning content call, because that is the material everyone cook in a different way. So, and I think it's very depends on the dictionary they are using it. So I think one thing I try to criticize here is like the dictionary, very like tailored, like very customer dictionary. Everyone doing their research using based their own dictionary. Okay, it's very difficult to comparison between this kind of when you have result. And you only based on your dictionary, someone based on his dictionary, then it's very difficult to comparison. So I think my methodology, I think, seems very simple. I think we follow this VAR. You know, when we calculate VAR, or actually short for, I think the same idea, using the univariate the distribution, the tail risk discounting. And I think our thinking, yes, it's too simple, but I think I like this simple, maybe catching something important. So we know it means a lot of information not rely independently on the technique we are trying to apply to this research. So and also I think this can be able to, for a comparison purpose. So I think you're also right. I think there's a lot more granular data probably we can do in terms of the honest. I think the questions that we can do separating questions and answer, and we try to capture the different tone, or we can capture, I think we can capture the different people asking, depends on the seniority or different position. I think it's possible we can do, but it's like will be expand this paper, maybe another research we can do in the future. But I think the what we're doing it using this difference and also using the tail distribution between, and then we'll be able to get away from this one because we comparison if they have like saying they are always trying to manipulating inviting these more optimistic people analysts to come into the earning conference call, then it will be when we are subtracting the past, then be able to get rid of this inference here. So even simple, but I think you doing the job like as what we are expecting for. So it is something better. I think we think earlier have this tone didn't have issues because as what I'm saying, the every deck Elon Musk when he's conducting the earnings call, they have his own style. He might be too optimistic when he's answer all the questions, but certainly one day the Elon Musk when answer the questions found very optimistic or very pessimistic, then there's an issue coming. So then I think I'm sure I of course I think there's many other issues in terms of innovative. I think in terms of methodology maybe it's not that catching as as other paper. I think like engagement, the tone, pitch, I think and also the audio thing I think quite interesting. But I think we just want to like cook this material, the simple and easy to interpret. Sorry, I'm not sure I answer your questions or not, but I try my best.
Yeah. All right.
And thank you very much, both. Yes, I agree. So you being simple is very good actually. But in my experience, and well, if it is a very, very big name, they only run ordinary least square. They do not really need to run even further than that. But I do not know whether you have the issues in the future. But I think maybe another area, if in my view, to improve it, is that I feel you towards to the measurement quite a lot heavily. So you try the different robustness, different thing on this, change and surprise measurements. But I was thinking about maybe you can add some robustness test to show maybe different industries, the results may be different across different industries. Some industries are more sensitive than others. So, for example, all different firms, or whether or not those firms have a person who like Elon Musk. So, so that can add a lot of other flavor to the paper. But as you said that this is a microstructure paper and they only focused on the market, but that's my field. So yeah, maybe for another project.
Yeah, thank you so much for your question. Yes, I think you're right. I think we can probably do some other heterogeneity tests in terms of the characteristics of the CEO, characteristics of the firm. I think one thing as traditional people do is like this impact will be much more pronounced when there's more opaque firm. So it's like very traditional, but I just don't know how much value we're going to add because already this paper already more than 50 pages. So we also need to think about the publication purpose. If too long paper now is maybe not very popular. So we probably just we can do this, but if they invite us to doing some extension, of course I'll be happy to do more. But we need some space for the future, the comment we might have when coming to the submission stage.
Yeah, understand. Yeah.
It'd be already too long. I think this paper is already too long. About 50. I think about the 12 tables, about 55 pages is way too long. We'll be cautious about the space of the table because there's many things we can do. I think you can do many in addition the research to this one. But I'm not sure what's the best we can incorporate, because now we try to capture the surprise, we try to capture the unexpectedness. I think it's an important concept we try to introduce here. But of course, we can introduce other one, opaqueness, or like transparency, or whatever agency problem here. Yeah, but I think we will lost the focus on paper.
Yeah, understand. Yeah, absolutely understandable. So, are there any other questions from the audience? Why are people so quiet in the new year?
I'm not present where.
No, you presented well. Don't worry. And the paper is very good one. Is has a lot of potential. But in that case, I think we are still settling down probably for the first week, and people just started teaching. So so let's say a lot of thanks for people who are here today to start the term and who contributed to the discussion. And thanks, Junhong, for your presentation and for your support to our activities. So I would like to close this session so that we can think more about the paper. We can deal with, we had another meeting in the morning. Actually, I didn't reply emails from this morning yet. So thank you very much again. I will see you next week.